back to our Indianomics special, View from the IMF. I have with me Mr. Vinals, currently Financial Counselor and Director of the Monetary and Capital Markets Department of the IMF. He has served in several positions and as the Deputy Governor of the Central Bank of Spain. Mr. Vinals, thank you very much for joining me. Well, we have seen the European Central Bank announce a deeper negative interest rate and announce a lot of further quantitative easing measures, including a long-term refinancing obligation. Is this enough to pull Europe out of deflation, you think?
Well, first of all, Europe is not in deflation. Europe is still with positive rates of inflation, but rates which are well below the close to 2%. That is the objective of the European Central Bank's monetary policy. I think that these measures certainly go in the right direction. These measures, I think, are important. I think that the combination of the augmented quantitative easing and further taking interest rates in the negative territory, all of this is going to be helpful to support demand and to support price stability. But it would be even better if monetary policy were not the only game in town, and if fiscal policy in those countries which have fiscal space and structural reforms were also to complement monetary policy.
Okay. Yes, I did hear you at the Reserve Bank of India, and you did refer to a greater reliance on fiscal rather than monetary policy. I'll come to that in just a bit, but what's, we are 2 months into 2016. The IMF in previous times has started with, a 3.7% growth for 2015, and we ended with 3.1%. Now I think you are starting 2016 with a 3.5% global growth forecast. Is there a downside risk to this forecast?
Well, the forecast that we have is that this year and next, things are going to be better than last year. This is our central scenario. But of course, we have also signaled that the recovery is vulnerable and that it is subject to downside risks. So there is some uncertainty associated with these forecasts. Now, this economic evolution that we are expecting, that the global economy would do better, will very much depend on what kind of policies are put in place by policymakers. So the more policymakers can put in place policies in a concerted manner that support confidence both in advanced economies and emerging markets, it is all the more likely that these downside risks will be coming down and that the economy would do as well or perhaps even better than what we are forecasting. So it really depends at the end on the policies which are put in place. But our central scenario is, yes, that the global economy would be better this year than it was the case last year.
Okay. What's the IMF's sense, or even your sense, of what China will deliver at the National People's Congress? The promise is 6.5% to 7%, but a lot of zombie firms will have to be killed or trimmed down. Do you think China can achieve both? Control the glut in steel and coal and petrochemicals and yet engender a 6.5% to 7% growth?
Well, again, China's future in terms of growth will very much depend on how the authorities carry out the economic and financial policies which are required to support this growth rate. In our forecast, we think that a growth rate between 6 and 6.5% is perfectly possible. And this is something that can happen because the authorities in China have the capacity to use fiscal policy, for example, to achieve that growth target. Now, it is very important also that China tackles decisively the problem of weak corporates. You have a lot of corporates in the mining sector, in the construction sector, which are not doing great. And these corporates' problems need to be addressed. And this is also very important because these corporates have a lot of loans with Chinese banks, and there is a potential for risk to be transferred from the corporates to the banks. So it is very important that China puts in place the policies to enhance discipline and to make sure that only the corporates which are really viable survive over the medium term. So this is not something which can be done instantly, but China needs to pursue over the next few years policies that will achieve the deleveraging of the corporate sector. That will be accompanied by some defaults of corporates, by some exit, by the need to restructure the debt of some corporates. But this is very important that it is achieved and that the process is not delayed sine die. It is very important to start the process, even if the process takes place in a gradual manner. And if that's the case, I think that China will be able to sustain decent growth rates in the future.
Okay. Yeah, we in India can understand we have perhaps less than one-fifth the amount of steel that China produces, and it's already feeling like a glut. But Mr. Vinals, what is your sense about the Chinese currency? China is doing a great service to the world by not allowing a rapid devaluation of the yuan, yet the outflow of dollars out of China is still thick and fast. Do you think China will or should resort to one-time depreciation to adjust to the reality on the ground?
Well, I think that at the end, the exchange rate reflects over time the economic fundamentals. And if China really continues the process of rebalancing growth and achieving a growth rate, let's say, between 6 and 6.5%, this is something which I think is consistent with the stability of the exchange rate vis-à-vis a basket. This is the policy that the authorities have announced, that they would like to maintain stability vis-à-vis the basket. And if the rebalancing of the Chinese economy continues, and if growth is somewhat above 6%, I think that in principle there is no reason, but there should be a significant depreciation or devaluation of the renminbi. Now, if these things were not to happen, then the exchange rate will have to reflect this state of affairs. But if China pursues balanced policies to make this growth rate happen between 6 and 6.5% at the minimum, I think that there would be no need for the exchange rate to depreciate very rapidly, and that stability vis-à-vis the basket could be maintained broadly.
Thank you very much, Mr. Vinals, for joining us and leaving us with a cautiously optimistic picture of growth in 2016. Thank you very much for joining us.